CNBC TV 18 special. I'm Shireen Bhan, and today we're going to be focusing on a company that is hoping that the revival in consumption is going to boost its bottom line as well as revenues. Joining us now is Sanjiv Puri, the Chairman and Managing Director of ITC. Sanjiv, many thanks as always for joining us here on CNBC TV 18. Before I get into specifics, I wanted to get a big picture overview from you. We're now firmly in the midst of unlock across the country. Most restrictions have been lifted. There's been more measures announced by the government. In fact, just yesterday, some new measures announced. What's the story looking like as far as a consumption revival is concerned across your businesses? What's the outlook today?
First of all, Shireen, thank you for inviting me. It's always a pleasure to interact with you. Well, I think we have recovered quite well since the days of the lockdown in Q1. And that is also visible in a lot of the high frequency indicators that we have been all reading about. Certainly agriculture, manufacturing looks on a relatively good wicket. There is of course stress on the services side, and metros have not really recovered the way the smaller towns and the rural areas have. So this is the broad picture. Now, from a segment perspective, see, FMCG is a sector that has done well. It's continuing to be on the growth path. As far as cigarettes are concerned, you know, there have been certain restrictions on distribution from time to time, localized lockdowns and so on and so forth. So that has kind of had its impact. And then as far as agriculture is concerned, it is fine. As far as paper and packaging is concerned, it's kind of an aggregate of consumption in the economy. So it's not quite at the pre-COVID levels, but I would say it's a smart recovery. All of these sectors actually are at a fairly good level, despite whatever restrictions or challenges there may be. The only sector that I would say is really under stress at the moment is hospitality. And that, I think, has started to show some signs of improvement, but still, I think it's fairly muted in that sector.
Okay, I'll pick up on each of those segments individually. And as you rightly pointed out, hospitality, of course, has been a sector that continues to face the brunt of the restrictions as well as the COVID impact. But Sanjiv, on the FMCG side, and you said that the FMCG business has seen a recovery post the lockdown. Are you back to pre-COVID levels? What is the capacity utilization across your plants at this point in time, specifically on FMCG and for the foods business specifically? What's the outlook?
Well, as far as FMCG is concerned, I think we are growing quite well. We are seeing two trends. One is fundamentally that staples are doing well, and it's the discretionary pieces that are a little muted. But compared to where we were in Q1, they have also recovered, but have not reached the pre-COVID levels. Staples are ahead; they're on a growth path. At an aggregate level, you know, you saw it also in Q1. Where on a comparable basis, we grew at 19%, backed by beefing up capacity, smart, quite quickly getting back our operations in place, and a slew of new launches, 41 launches in the first 3-4 months of the lockdown to deal with the emerging consumer needs. You know, Savlon saw a lot of variants being put out into the market, which have been received well. We saw Be Natural put out immunity juices. We saw Bingo get into the namkeen snacks. So a number of activities have happened to deal with emerging demand. And that's why we have posted robust growth. And we are seeing growth at an aggregate level. Of course, the only segment I would say that really is under stress at the moment within FMCG, which I can separate out, is the education and stationery piece, because schools have not open, and that of course is something that will recover as and when schools get back to normal. But otherwise, I think we're doing quite well in FMCG. Our new launches are working well. Our trusted brands are growing well. Our agility in distribution is aiding our growth. We were first off the mark to develop some alternate routes to reaching the consumer through partnerships, through ITC stores on wheels, and so on and so forth. We are quite optimistic on FMCG. We do believe that we will continue to grow. And whilst there are certain, economic issues at an aggregate level, I see the prospects of FMCG particularly with respect to the portfolio we have, I see it fairly robust.
Okay, so let's break down the FMCG portfolio, Sanjiv, specifically, because while it is a significant contributor as far as revenue is concerned, making up about 28% of your revenues today, the contribution to the bottom line continues to be a concern that analysts are raising. Now, don't give me a 2030 horizon as far as the FMCG business is concerned, but explain to me over the next 3 to 5 years, what is the focus that you are likely to see on the FMCG business in terms of EBIT margins? If I take a look at the EBIT margins, they have improved, but still hovering between 2.5% to 4.5%. So what's the outlook there specifically on the bottom line contribution as far as the FMCG business is concerned? The last conversation that you and I had, you did say that, investments are more or less now done as far as the FMCG business is concerned. Is that a fact? Are we likely to see a significant rationalization of your FMCG portfolio? What should we expect?
All right. So just to give the correct figures first, see, in the last 3 years, FMCG margins have expanded by 460 basis points. This quarter, it has expanded by another 170 basis points. EBIT margin is not yet where it should be, but it's on a robust trajectory, and I believe that this trajectory will sustain because we will get the advantages of scale, the premiumization that we are doing in the portfolio, and the benefits of the investments that we have made in supply chain that are going to bring operating efficiencies as also structural efficiencies. So let me also put this whole thing in a perspective. See, and more of this work has happened in about a decade and a half. We have 25 mother brands with a consumer spend of 20,000 crores approximately. Now, many analysts have also called out the fact that all this has been built organically, and there are hardly any parallels where this scale has been achieved in this period of time. And we have done it at a cost of 1.6 to 1.7 times the top line, as against what the analysts estimate that if we had gone the inorganic route, we would have had to spend 4 to 5 times this. So we must keep that in perspective also. And the fact is that we have invested with bold aspirations to create a large FMCG business, and we did it much ahead of time. And the reason, and now I think we are in a good position to harvest the benefits. And why do I say that? We have 25 robust brands across multiple categories, and these categories represents a consumer spend of about 2 lakh crores today. In a few years' time, this 2 lakh would be 3.5 lakhs, and so on and so forth. So it's a large space. These brands will continue to grow with the investments that we are making on innovation, and there are many that I can call out, and then the investments we are making in communication and the investments we are making in enhancing reach. And our research and development platforms, the strategy that we have adopted over a period of time at the ITC Life Sciences and Technology Center, where we have gone the platform way with specialization, I think is paying rich dividends. And I'll just call out an example. Just in a short span during the COVID time, Savlon brought out many products to the market, and this was possible because of the platform. We were first to bring in a disinfectant spray. We've now got a disinfectant fabric spray. We have a multi-purpose cleaner, wipes, and so on and so forth. Even we brought in a very innovative product, Nim Wash, for cleaning fruits and vegetables. It's a completely natural formulation. Then we brought on Be Natural immunity juices, right? And all this we could bring it out because of our platform approach and strength of research and development. So this foundation, I'm saying, is really solid. And we were able to get all our operations aligned and running, in fact, across the group, 180 locations were running in 10 days. 85% of
Right.
our
No,
distribution
Sanjiv,
operations.
on that, let me interrupt you there, because you're talking about the synergy benefits that have been able to accrue to the FMCG business on account of what the group holds together. So then the question is, and I don't know whether this is a realistic possibility, whether it is being considered actively or in any form or fashion at all, is a demerger likely, given the fact that your stock continues to be under pressure, largely on account of concerns with the cigarette business, as well as what the contribution is going to be of the FMCG business to the bottom line. In terms of unlocking value, is a demerger at all a consideration? Could it be looked at?
Okay, I'll just come to that in a moment, but let me just complete 2 points in my earlier response. Really to say, besides innovation and the focus on distribution, I think the supply chain that we have put in place with proximity to market, which gives advantages in cost and servicing, and the whole strategy to use our agri backend to create a localized agri value chain to the extent possible, is going to give us structural advantages over time as we scale up. So despite the fact, what I'm really trying to conclude and say, despite the fact that our portfolio today has categories which have acquired scale, categories which are small, which we are going to scale up, and categories that we are incubating, and facilities that have been designed to give structural advantages and scalability. So there are gestation costs on both ends. Despite that, we are seeing a robust growth in profitability, and I believe the trend will sustain. Okay. As far as this whole issue about, I think you're coming from a broader issue of shareholder value. This is an area that is certainly topmost in my mind, topmost in the mind of the board, and it is quite, in fact, surprising to see the price, the position in the market, because in the last 3 years, our EPS has gone up by 47%. Our return on segment capital has gone up from 61 to 72%. Each of our businesses, I'm talking about older businesses, are leaders in their segments, whether it's paper, agriculture, hotels. They are leaders in the quality of products and services. They are leaders in terms of the superior financial metrics that demonstrate our fundamentals are strong. We have robust cash flows. We are debt free, and we have good quality of governance. For some reasons, this is not getting reflected in the stock price. And this is despite the fact that 41 out of 42 analysts actually give a buy or hold rating with a median TP of 240. So yeah, I do understand that there are certain concerns as far as ESG, taxation, and more recent ones because there have been some restrictions on distribution. So these are concerns. I do understand, but notwithstanding, or even in the context of all these concerns, I think there's intrinsically a lot more value into the stock. Even at ESG, we are AA plus. As far as
You've given us a whole host of numbers there, Sanjiv. I'm jumping back in to pick up on one of the comments that you made. When you said that shareholder value is uppermost on the minds of the board and you personally. Now, how should we interpret that? What is that going to result in terms of tangible next steps?
So I'm just giving you the context. And just to also say, ESG is also an area that is evolving. There are more than one view on how it has to be looked at, whether it is by elimination of sectors or whether it's on manner in which business is conducted. And in our case, that is reflective of a ranking of AA plus. Now, having said that, we have looked at various tools and facets and various suggestions that have come on how to create shareholder value. It starts with the suggestions on capital allocation, dividend distribution. There are suggestions on buyback. There are also suggestions on restructuring. And we do take all these suggestions very seriously and examine it and do what will create sustained value, not just fleeting value at a point of time. So in that context, let us see what have we done in this context in the recent past. We have come out with a very clear capital allocation policy. In the hotel segment, we have said we're going the asset right route, which means that the focus will be on management contracts. As far as dividend distribution is concerned, we have a clear policy. 80 to 85% of dividend will be distributed, and the yield at today's price is upwards of 5.5%. As far as buybacks and restructuring is concerned, as I had said in the AGM, this point had also come up in the AGM, that we take note of these suggestions and the board will look at it, and whatever needs to be done to unlock or create value for shareholders or stakeholders, the board will definitely look at it, but it has to take a holistic view, keeping the long-term sustained growth trajectory in mind. And we have, of course, in the annual report already called out that hotels is one area we will examine. The other areas, yes, we have noted it. We are working on it. We will examine it. And as and when we find it's the right thing to do, and it will create sustained shareholder value, I think the board will examine it in that context. And let me also mention, the fact that just as evidence that board is very concerned about shareholder value, is that many years back we started this foray into FMCG and took a path less traveled, and with a very bold ambition. Was a fact that we did realize that at some point of time, there could be some headwinds in some of our traditional business. So we have to create new avenues for shareholder value. And today, there are suggestions being made on restructuring and so on and so forth. So really, I think first step, we have created a lot of value, which the question is, what is the right time? What is the next step as far as that is concerned, right? So let me put that in perspective also.
No, let me pick up on that then, Sanjiv, because you pointed out that as far as hotels are concerned, asset light is what the strategy is going to be. You talked about your dividend distribution as well as capital allocation. Now, on the buyback and restructuring, let me address that issue. CLSA has put out a note, and it says that when the issue of demerger comes up, CLSA believes that cross synergies may restrict the possibility of a demerger. Would you go along with that interpretation? Do you believe that that is something that will weigh on the minds of the board as and when you decide to look at any restructuring? You spoke specifically about perhaps hotels being the first where you could consider hiving it off. What is the broad timeline that we're looking at?
See, I at this point, all I can say is that we have certainly taken note of the suggestions. There are pros and cons of each choice that we exercise. Ultimately, we will do it when we believe and if we believe that that will not only create shareholder value, but it will enable the business to grow on a sustained basis, right? So it also depends on the life cycle and stage the business is, and maybe some other innovative models that can be created to deal with synergy and so on and so forth. But I can't, go beyond it. It'll have to be, unless it is for something the board to discuss and debate. Only then I can come back. As far as hotels is concerned, yes, we have flagged it off that we will explore alternate structures. But that annual report is actually reflects a position that was there pre-COVID. Now that we have this situation of that sector being under stress, so the timing, we'll have to take a view on how the recovery happens. So at this point of time, on what we have called out in the annual report, for me to say that in certain period we will have a clear roadmap, I think at this point of time it would not be possible given the stress that the sector is facing.
Okay, so you're saying because of COVID, the restructuring of the hotel business has been put off for now. But give us a sense. You talked about a roadmap, Sanjiv. Whether it is restructuring, not just of the hotels business, but the issue of a demerger, maybe of the FMCG business, etc. What's the roadmap? When do you believe that you may, in fact, take a proposal to the board? When do you believe that you may move forward on some of these ideas? You said that you have taken note of the suggestions that have come your way. But what's the broad roadmap in terms of when we can actively see you take a call on either of these options?
I will not be able to give you any more information at this point of time. I think we are examining, because we have received this suggestion, we are examining it, and only when, and that's what I said in the AGM, that whatever is right for creating sustained shareholder value, the company will be open to examining. So that's what we are doing right now. And you rightly touched upon some challenges of synergy, because those have been the factors that have helped us grow in a robust fashion. So we have to do a very detailed study on it, and then only we can come to a final perspective. I'm just repeating what I've said in the AGM, that we are open to it and we will examine. Sure. And beyond that, Shireen, I cannot tell you anything more. It's a strategic issue, and until the board has debated it, we cannot really. I cannot really tell you anything more.
I understand, and I appreciate the fact that you can't share more at this point in time, Sanjiv, but at least give me some milestones for the FMCG business. And again, not 2030, the next 3 to 5 years, what is the trajectory that you see? What are the milestones, the targets that you're setting for the FMCG business?
See, we do not give, Shireen, we do not give guidance, so I cannot give you the figures. What I can say for sure is that we are on a robust path. We will give industry-leading growth, and our trajectory of margin expansion will sustain. So that is what I'm saying. And in every business, as I've said before, that our aspiration is to be in a leadership position, and it is with that objective that we are also pursuing our interventions in the FMCG space. We have built a strong foundation, the right capabilities, the right supply chain infrastructure. I mean, some of it is in work in progress. And more importantly, we have great talent with us, and talent that has created categories from scratch, rolled up their sleeves and created it. We call them professional entrepreneurs or pioneers. I think that's a unique strength ITC has got. And it is this talent that has demonstrated its agility and resilience in a very difficult period. And all this gives me immense confidence that we will be on a higher trajectory of growth compared to the industry, and we will also sustain our trajectory of margin expansion.
Okay, so higher trajectory of growth and margin expansion versus the industry. But Sanjiv, you talked about how you've built this portfolio organically. Are you at this point in time now actively looking at making acquisitions that are value accretive on the FMCG side? Can we expect something on the annual, especially since this is now a big focus area where you hope to drive growth as well as expand margins?
So acquisitions is certainly one lever of growth we are open to, and we have looked at many opportunities. However, we have gone for opportunities which have a strategic fit to our portfolio. There are spaces that we have called out where we would be interested in acquiring. And for example, I can only tell you what we have done. For example, in the hygiene space is a space we have flagged off. Naturals is a space we have flagged off. So that is why Savlon fitted well, Nimile fitted well, and both these acquisitions have done very well. Savlon was a 50 crore brand 5 years back. It is getting into a run rate of 1,000 crores. Nimile in 2 years is 4x of what we bought it. I think we are very encouraged with our experience. And so anything that fits strategically, is aligned to our roadmap, and is value accretive. The multiples in FMCG are also high. So I must make sure that it is value accretive. I should be able to run that business better than the current owners, which means I should be able to grow it faster. I should be able to add to the margins by synergy, and there should be sufficient headroom to grow. So it's actually in that context also that we made a more recent investment in Sunrise, and the penetration of branded spices in this part is comparatively lower, and there's a huge headroom to grow, and that's why we acquired that brand. So we will be open to it. We have looked at many in the past. We've either not bid for it because we found there was no strategic fit or no value, or We bid for it at a value that we thought right, and we did not get it. And also, I must say,
Right.
the quality of what we buy is very important. The quality of the financial reporting as far as what we buy is very important. The quality of the equity is very important for us. So all these parameters, if all these boxes are ticked, we will certainly be open to doing it. We are not going to just because we have a good cash balance. We are going to we're not going to be adventurous or aggressive. It will be with a lot of financial discipline.
Okay, financial discipline is going to be key when it comes to the FMCG business and possible acquisitions. But let me end then by asking you about the outlook as far as cigarettes are concerned. Volumes, declining or growing very, very slowly. There has been some degree of market share gains made by your competitors. Also, there is always the possibility of higher taxes, cesses, etc., especially given the fact that compensation cess kitty is facing challenges at this point in time. What's the outlook now as far as cigarettes are concerned? What should we expect there?
So let me first say that this is very closely related to how the taxation unfolds. So in periods where taxation has grown at a very high rate of, say, there was a period where it grew consecutively at over 15%, but revenue grew at under 5%. There's also a period where there was relative stability, and for about 18 months or so, and the industry was able to claw back from the illegal industry, and revenue growth for the government was 10%. I'm taking revenue growth as a surrogate for how volumes have performed, and it's very well correlated. So it recovered. So what it really shows is that when we have stability or moderation, the legal industry is able to claw back. I think that's the principle that is there. And India actually has got today 1 in 4 cigarettes that is smuggled. And whenever taxes go up, the smuggling gets a boost, and it also shifts to some revenue inefficient forms or sectors that are sometimes not even paying taxes. And as far as market standing is concerned, let me say that if you analyze trends over a decade or so, you will find that there are and you have the results of all the companies available. You can do the statistics. You will find that things move around the median by about 1% or so, but there are impacts of base and so on and so forth. And we as a company will defend whatever is required to be done, our market standing, and we will go after value accretive segments. It does not make sense for me to pursue segments that are not value accretive. And sometimes I may also choose to pursue certain segments by making certain back-end investment. So I have the right efficiencies to make even that segment value accretive, which is what I have done. So there was a short-term blip, and I think we are recovering quite well. So there, I mean, we are covering ground quite well there, and I have no doubts that we will make good progress, continue to make good progress in those segments.
Okay. In the last 30 seconds, Sanjiv, unfortunately, we're running out of time. In the last 30 seconds, you did say that the underperformance of the stock is a cause of concern. The stock is now at an 8-year low. You've got the ESG overhang, FII ownership down from almost 18% in 2018 to about 14.5% in 2020. Given this, do you believe that this underperformance is a reality that you are going to have to live with, or is there anything that that you can do by way of tangible decisions to try and change this?
I've already narrated the strong fundamentals of the company. I've already said that there are things that we will be examining. And let me also end by saying that we have seen sometimes, stocks go through cycles where in the short term, what the market appreciates is different from the intrinsic value. But in the long term, it always converges. And I truly believe that our stock is, our company is on very solid foundation. We have robust strategies. We have leadership in many segments, and other segments we are making progress. We're also looking at some of the other areas that you spoke about. We've looked at some other areas we are looking at. But ultimately, we will do whatever is required to create shareholder value. And I'm sure that in the long term, the true value of the company and the market value is actually going to converge. Even ESG, is an evolving area. It's an evolving area. There are different perspectives that are emerging. So I'm pretty confident that in the long term, the market will recognize the true value of what ITC has created.
All right, Sanjiv Puri, we'll have to leave it there. Appreciate you joining us here on CNBC TV 18 to take us through the outlook for the cigarette business, but more importantly for the FMCG business, as well as some of those other strategic decisions where you're yet to take a call on things like buyback, restructuring. Of course, you did tell us that the plans to restructure the hotel business will have to be put back on account of COVID. Thanks very much, as always, for your time. We will take a break there on the Newsmaker, but there's a lot more coming up. Don't go anywhere. We're back in a moment.